Gonna stop annotate mode. From the current slide. Sweet. Sorry for the whole mix up. That was my bad. Right. So this is the second of 8 episodes or videos, I guess, that I have planned regarding my podcast to get people more involved into investing and understanding what they can access as a retail or an individual investor. Just some quick disclaimers. Again, this is not financial advice. This is purely my opinions. I only intend to educate my peers on what's out there, what they can access and do with their money, or at least what I think is available to them. Again, content is being recorded so that it can be published to YouTube at a later time, so that people who are not here can, experience or enjoy this. Right. So, just a quick macro view again. We discussed why we need to invest in our previous episode. This week we're going to this today we're going to discuss the mechanics of a stock market, because there's not just one; there are actually multiple across the world, so to speak. And then next we will discuss the metrics and factors affecting individual stocks. I think that's about what I'm going to summarize for now. Right. So let's begin by defining what a stock actually is. It's also called a share or an equity or a security, as you can see at the bottom of your screen. So all of these are referring to the same thing, so to speak. These are basically issued by a corporation or a company to raise cash for their operations. So rather than selling off assets, they can choose to sell a part of the company to a stockholder, and this would in return give them cash to carry on doing their businesses and fulfilling their requirements as such. If you remember last week, we discussed corporate bonds. These are not the same as corporate stocks or shares. The primary difference being when you own a stock or a share, you actually have ownership of a company. Whereas with a corporate bond, it's basically a corporate IOU, wherein the company promises to pay you back a principal that you gave them, plus some interest on top on a regular basis. uh, you may ask how this differs from a government bond, for example, or why anybody would invest in corporate bonds when there are governments that are backing such documents as well, or such instruments as well. One of the the things that come to my mind quickest would be the rate of return, or the interest rate on corporate bonds often tend to be higher than the government. So if you look at the 10-year treasury yield of the American bonds, so to speak, which is a 10-year bond, is actually sitting at 1.6% right now. And this is making big headlines in the stock market, if you do follow financial news. Um, whereas I can almost guarantee you most other companies, big companies, would tend to offer a few percentage points over what the treasury would do over the same period of time. So at the end of 10 years, well, actually over 10 years, every year, you would with a treasury yield, you would get roughly 10.16% back every year for the next 10 years. It could be paid quarterly or monthly or annually. It depends on what kind of contract that is signed up. I don't deal in bonds, so I'm not aware of how it's dealt with. But that's basically what corporate bonds and the difference between these and corporate stocks are. So we're just going to stick to stocks for now. Stocks can be offered in various different ways. The two most common are when they're offered directly to a select group of wealthy individuals. And this is called private equity, just for your information. It's just a formal name given to it. And you can see this happening actually live on TV, not live on TV, but it shows up on TV in shows such as Dragon's Den or Shark Tank, wherein business owners who own maybe 100% or a portion of their business shared with a family member or whoever it may be, they come to an external slash wealthy investor asking for some money in return for a percentage, for a large percentage of their any percentage of their business, and that's known as private equity. Or stocks, and this is more common, stocks can also be directly published to the public to purchase readily. So that in this case, that's referred to as an initial public offering. And some recent initial public offerings were by Bumble, the dating app, Roblox, the gaming platform, I suppose, and Airbnb, which is the hosting app. The way it works in IPO is the company would tend to determine the price of the initial the initial stock price at the point of IPO. If it's $50, that's what the company set it to, and the cash raised by selling those millions of shares on the very first moment of the IPO to the public is the cash that's given to the company issuing these shares. Post an IPO, 1 minute later, if I buy a share directly from the company offering the IPO and sell it in the open market, the difference in profit between or loss between the IPO price and the price the moments later, that profit or loss then becomes mine or whoever the investor may be. That's the two ways companies tend to raise capital through the issuance of stock. It can also represent an ownership of the company as well, and that is represented by the fraction of stock that you own divided by the total number of stock that are available in the market. So if a company issues 3 million shares and one of the directors owns 1 million shares, they effectively own a third of the company. That's basically what a stock would summarize to be. Right. So the company also has the right to issue more stocks or buy them back. Issuing is often referred to as dilution, whereas buying back is just buybacks, as you can often hear in the news as well. This is not same as a stock split. That's what Tesla and Apple had sometime last year. In the case of a stock split, the ratio of shares is proportionally divided to everyone. The new shares coming in is proportionally divided amongst everyone. So nobody's percentage ownership actually drops in a dilution in a stock split. Whereas when a corporation issues fresh shares, they're diluting everyone else because they're bringing new stock owners or company owners on board by doing so. And you can see this actually happen in Tesla when they were on a high horse. They actually issued like 5 billion new shares, and the stock price barely dropped. But in a smaller company, this a stock price drop would definitely occur, or most likely occur rather. uh, the point of owning a stock, or the reason why people would buy stocks, is because these would give the owners of the stock a right on the company's assets as well as future profits and earnings. So every single penny that the company makes, profit, not in terms of revenue, but profits, you as a stock owner actually are entitled to a portion of that, depending on the ratio of stocks you own compared to the outstanding stocks. Like all investments, the point of investing is to grow your wealth over time. And in terms of stocks, the reason most people talk about stocks, or why I'm focusing on stocks as well, is because they have provided the largest return on capital. I.e., if you put 100 quid in, you would get a lot more out with respect to stocks than you would with flipping houses, or buying cars or flipping cars, or gold bars for that matter of fact. That makes it really easy to get in and out, to trade these stocks. If you're doing it for gold bars, people are going to ask you how, what bank you robbed. Or Bitcoin, again, is being criminalized in a few countries as we speak. And you've got flipping houses, which can be on the market for months on end before you actually get an interested buyer as such, no matter what you paid for or whatever the price be. It involves several I'm not loopholes, procedures to go through, which can be quite a headache. Whereas I can buy a stock and sell it 10 minutes later, either making a profit or a loss without any hindrance as such. So, trading stocks. When we say we trade stocks, it's mostly happening on exchange, a stock exchange, so to speak, or some people also refer to it as a stock market, which kind of makes sense. These actually used to be physical certificates that are traded in a bull pit, for example. For example, that's what used to happen in the 90s, wherein brokers used to exchange cash at the end of the day, or take some capital at the beginning of the day from their clients, ask them what their order for the day was, and the broker's staff would then go and deal with other staff from other brokers to exchange these certificates, or deal with them and scream over each other. If you remember watching the 90s clips, they would scream over each other, write down their notes, and at the end of the day they would settle their certificates and cash. It's mostly been digitalized recently in the last 10, 15 years, 20 years, and this has made it significantly cheaper and more efficient, hence making it applicable for zero commission to take place. And that's how the masses can now get involved in trading stocks, rather than just the elite who who've got money to spend on fees or brokerage fees, or worry about the speed of the trade taking place. So yeah, they've mostly been digitalized. However, since they've been digitalized, the rules of the market don't change as such. The mechanics do, but the rules do not. So participants in a stock market, that's you as a buyer or seller, are still buying or selling to someone or from someone. This is a person, a counterparty to your trade. They're taking the opposite side of whatever side you've taken. If you want to buy a stock, they're selling you this, or vice versa. In modern times, that someone is most likely going to be referred to as a market maker. They make the market. They're basically, I will go into market makers in the next slide, but I think the image on the right sums it best, wherein most of your trades will go through a market maker, whereas a very small percentage would actually go to other traders like yourselves who run small accounts or medium accounts. It's completely random. The market maker is like a pool of stock that they own, several millions actually, if we can come to the next slide. So market makers are firms or even wealthy individuals who decide to participate in a particular stock or several stocks. So they've got large amounts of capital and are willing to buy and sell large quantities of particular stocks. So some market makers may not dabble in Apple stock. Some of them may only dabble in Apple stock, and vice versa. Most of them would have their hands in as many as they can afford to do so. What market makers do is they're willing to instantly and simultaneously buy stock from you at a low price, as well as sell the stock at a slightly higher price to someone else. So that's what's referred to as the bid price, wherein the market maker or the market is bidding for your stock, and the ask price, which is what the market is asking from you when they want to sell you the stock. They also tend to provide liquidity by the virtue of being able to deal instantaneously and simultaneously. They provide the ability for a retail trader or anybody to get in and out of a position relatively quickly, easily, and efficiently, so to speak. Um, or cheaply even. So what they tend to do is provide you a pool. So if you want to go and buy 1,000 stocks, these people will be there waiting for your order at the ask price. Or if you want to sell them 1,000 shares, they'll be there willing to bid you, give you a bid price for the 1,000 shares you want to sell. And this is what's often led to the recently defined or the always existent bid ask spread. The bid ask spread is basically the difference between the ask price and the bid price, and it's usually a couple of pennies depending on the liquidity of the stock, how many people are involved in the trade. This spread is what the profit of the market maker is, and that's a fee that they charge you for undertaking the risk that they do. For example, if everybody feels like selling based on bad news, then the market maker sitting on millions of stock, for example, is taking a huge risk, as the value of his entire lot or their entire lot just drops as the market keeps on going in a selling frenzy. uh, Most modern market makers now just use algorithms to trade stocks. There's no human, sitting there and watching these things. It's just algorithms designed to function and trade as effectively and efficiently as possible. In fact, these are now become it's become a race against time, to be honest, and people are paying millions, or even in some cases billions, to set up an office just below the exchange, set up a server, rather, not an office, a server just below the exchange, so that they can get the information as quickly as possible and sell these stocks or buy these stocks from the rest of the market. And these algorithms tend to identify the best price at which the least number of participants will be unhappy. It's not about maximizing happiness, it's about minimizing unhappiness, because there's always someone who wants to pay for a stock less, i.e. give a lesser bid, or sell a stock for more, and hence ask for a higher ask. But by using these algorithms, what they try to do is maximize their own profits as well as provide a liquidity to the market. Market makers are more of a rare term to use now. They're also referred to as high frequency traders, and you may have heard of them. And they're very prevalent. They're more prevalent in America than they are here in the UK, but they do exist. They're the ones who provide the liquidity that we see in the market. So, uh, consequently, your bid ask quote, which is the price you're shown or given as per your broker, is defined by the number of buyers who are demanding for the for the stock for the stock, as well as the sellers who are able to supply the stock. So it's basically your basic demand supply curve, wherein if you've got more buyers than a sellers, the price of the stock will just ramp up, as the people who want to sell can ask for higher prices, and vice versa. If there are too many buyers, too many sellers, sorry, and very few buyers, then the price would go down, a to entice buyers, as well as the oversupply of stock that has just flooded the market. Finally, this actually is the last slide. Yeah, so there are a few stock exchanges around the world. So the NYSE, the New York Stock Exchange, the Nasdaq are the two biggest in America that are most commonly known. LSE is the London Stock Exchange. BSE is the Bombay Stock Exchange in India. And you've got about 47 major stock markets across the world. Like most major economies tend to have their own localized stock exchange, but that does not stop companies from one nation from listing in another, which is why you've got so many Chinese stocks on the New York Stock Exchange, such as Neo or Alibaba, or so forth, so on and so forth. So, just an example, some of the most famous stocks on these exchanges on the NYSE, you've got Visa, Walmart, AT&T, and Disney. On Nasdaq, you've got most of the tech stocks tend to list on Nasdaq. Most people tend, I mean, the reason people would tend to go for a NASDAQ listing as opposed to a New York Stock Exchange listing is mostly to do with the fees that the NASDAQ charges. The stock market will charge the company a fee to be able to list on their market for providing the exposure that they get on the stock market. So NASDAQ tends to be slightly lower than the New York Stock Exchange. Obviously, the LSE has monopoly over the UK market for now, and you've got Unilever, Royal Dutch Shell, and you've got AstraZeneca, which is your medical company making the vaccines for COVID. And on BSC, you've got big companies like Reliance, Tata Consultancy, and HDFC, which is like a big Indian bank. And of course, each of the big stock markets would have their biggest players in them. Like the UAE stock market has Emaar, which is a property developer, as one of their biggest players in that market particularly. And yeah, I think that's about wraps it up. So if you've got any questions, feel free to add them in chat, and I'm happy to respond to them right now. Or feel free to catch me, as most of you know me personally anyways. So feel free to stop me for a second and ask what's up, or if you've got any other questions regarding this particular episode, then by all means send me a text or just catch me in person. As usual, I've got my quote on there, and that's, I think, by Warren Buffett himself. Yeah, and as I upload the slides, you will get a link to all the references, or some handy references that you may begin to start reading for your own benefit if you choose to do so. Brilliant. I think that's about it. Yeah, that's the next one. Cool. Thank you so much for your time. Yeah, cheers.